The impact of the green transition on the mining and metal sector is fast becoming ubiquitous. The global push towards green transition and a low carbon economy continues to gather pace, emboldened by the latest agreements at the COP26 summit. Environmental regulations continue to make progress amidst the spread of carbon pricing mechanisms, and the 2021 methane pledge signed at the COP26 by many mining countries except Australia. We believe this will lead to structural evolutions in the sector as the pace and trends of the green transitions will remain top of mind in 2022, posing both risks and opportunities to mining and metal players. As you can see on the infographic here, ESG requirements are affecting financing, investment trends, transparency requirements, sales and price opportunities, and increasing costs for miners as well. In terms of risks, we believe that miners will face a pressing need to reduce their environmental footprint and meet ESG requirements in order to contain the upcoming rise in GHG emitting costs due to carbon pricing, to meet regulations as well as to access capital. With capital availability increasingly linked to ESG ratings, miners will need to demonstrate their achievements. Reducing emissions will require large investment from mining and metal players, as it will require them to transform their operations by investing in renewables capacity, in advanced technologies that are less polluting, such as automation and green hydrogen. As such, decarbonization will absorb a rising share of capex, which would limit investment capacity for other growth areas. Meanwhile, mining and metal players will also accelerate their efforts to benefit from the new opportunities brought about by the green transition starting last year and also this year and going forward. Last year, 2021, already saw a number of companies invest or consider moves in this direction, and 2022 will likely see more developments in this sector. Companies are likely to follow quite a number of strategies, actually. These include, first, boosting exposure in energy transition materials via investments in new projects and acquisitions of existing capacity. Some companies without prior exposure to the energy transition materials are also trying to diversify towards non-core mining segments into green or battery metals. Second, spinning off higher growth businesses linked to the green transition to unlock value. Third, investing in product differentiation to benefit from green price premiums on lower carbon products. Fourth, acquisition of competitors in order to scale up capacity quickly in growth markets. M&A activity has been particularly dynamic in the lithium sector last year, which has seen a huge flurry of deals. We also believe that this is just the beginning of a consolidation phase in the lithium sector, and more activity is definitely expected this year. In other sectors, large miners could also look at investing in early stage projects that are relatively small to moderate in size. And last, fifth of all, diversifying outside of mining, directly into the energy transition in order to find new growth markets. Aside from company investment trends, we believe the green transition will also bring with it deep changes to mining, to the mining metal supply chains and market structures. Product differentiation based on green or ESG credentials and assorted price premiums will make some metals more of a specialized product sector and less of a bulk commodity material. And this megatrend will also potentially change decade-long market share trends with the emergence of new consumption growth hotspots, as you can see on this table here. For example, the boom in the renewables and battery use will not only lift copper demand, but also redistribute geographically to some extent demand markets. China's demand market share will decline slightly out to 2025, while the US, Brazil, and the EU will see their consumption revive. Lastly, the energy transition is full of complexities and contradictions, one of them being that metals are a critical input for green transition technology, including renewables and batteries, while the mining sector's social license to operate is increasingly being eroded amidst rising public opposition to mines. This contradiction is likely to come under the spotlight this year as demand for energy transition commodities rise. These are copper, lithium, nickel. They're the top of mind right now. And different stakeholders, such as companies and sometimes governments, they will aim to support and accelerate local projects to produce these strategic materials. The growing momentum behind the green transition suggests that rising public interest, there will be rising public interest in environmental topics, including pollution and biodiversity. And in turn, this implies there will be additional scrutiny on mining operations around the world. So this contradiction between the rise in demand for green transition materials and the opposition to new mining projects could lead to a slowdown in new projects' progress, to a thinner than expected project pipeline, and to higher for longer metal prices. In turn, this could slow down the progress of the green transition, but we only see all this as a very low-risk scenario for now, given the very strong drivers behind the green transition.